Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. Consumer inflation accelerated to a 5-month high in September to touch 7.41%. And at 8.6%, the inflation in food items was at a 22-month high last month. So as the retail inflation stayed above the upper limit of the 2 to 6% band for the third straight quarter, all eyes are on the RBI now. So today we ask, what can the central bank do to calm the prices?
India's retail inflation, based on the Consumer Price Index, soared to 7.4% in September, up from August 7%. This rise was fueled by higher food prices. Data released by the National Statistical Office showed that food inflation, which accounts for nearly 40% of the CPI basket, came in at a 22-month high of 8.6% in September. The latest reading highlights the Reserve Bank of India's challenges in bringing inflation within its medium-term target of 4%, with a variation of 2 percentage points on either side. Inflation has now remained above RBI's upper tolerance level of inflation of 6% for 3 consecutive quarters. RBI Act says that the central bank will have to submit a report to the central government explaining the reasons for failing to meet the inflation target and remedial steps to rein in the price rise. RBI is facing such a consequence for the first time since the onset of the inflation targeting monetary policy framework that came into effect in August 2016. Last month, RBI Governor Shaktikanta Das had said the central bank considers the communication to the government missing the inflation targets as privileged communication and will not be making it public. Inflation had overshot the target for over 3 quarters during the initial months of the pandemic as well, but a technical shortcoming in the data collection, wherein data was collected without visiting the mandis because of the lockdown, had helped ensure that no such explanation has to be done by the RBI at the time. RBI's Monetary Policy Committee has raised the repo rate by 190 basis points since May to 5.9%, and economists expect it to raise rates yet again by at least 25 basis points at its next meeting in the first week of December. Late withdrawal of monsoon and intense rain spells seen in some states has had an impact on the price of perishables, especially vegetables. During September, prices of vegetables increased 18.05% from a year ago, while cereal prices rose 11.53%. Spices added to broad-based food price pressure with 16.9% inflation. Clothing and footwear prices jumped 10.17%, while fuel and electricity prices increased 10.39%, staying above the 10% mark for the 4th consecutive month. Key rice-producing states such as Uttar Pradesh, West Bengal and Jharkhand reeled under excessively deficit rainfall this season, weighing on paddy sowing and anticipated output. The weakening of the rupee by over 10% this year has made imports costlier for consumers and businesses. Meanwhile, industrial output contracted 0.8% in August after showing a 2.2% growth in July. A note by Quantico Research said that slowdown appeared to be broad-based with noticeable drag in consumption-oriented production, even as investment-oriented production too has seen loss of momentum in the recent months. The International Monetary Fund on Tuesday cut its growth forecast for India to 6.8% for 2022-23.
It is important to make a distinction between the underlying drivers of inflation. Focusing on the most recent inflation print of 7.41 in September 2022, we note that nearly 62% contribution to the headline CPI came from non-core items of food and fuel. Since this part is largely interest rate agnostic, monetary tightening is unlikely to have any impact here. Having said so, it does not mean that monetary policy would be irrelevant to the current context. The role of monetary policy is extremely crucial in avoiding spillovers from non-core inflation to core inflation, and further to inflation expectations in the economy. While the RBI has raised repo rate by 190 basis points cumulatively in a short span of 5 months, the transmission happens with a lag, typically of about 2 to 4 quarters. Going forward, we believe there is still some room left for pushing real interest rates to positive territory, and hope that the MPC would opt for another 35 basis point of rate hike in the upcoming policy review in December 2022. This, we believe, also needs to get complemented by government action, especially in case of non-core items of food and fuel, to reinforce the inflation targeting credentials of the economy.
Since the inflation print is heavily influenced by food prices, which are volatile and lately affected by global developments, the RBI's toolkit is limited. Thus, actions by the central bank will have to be complemented by further government steps on non-core food and fuel items. Failure to do so will damage India's inflation managing credentials.
Imported inflation due to the war is also adding fuel to already high retail prices. The effect of war and a global slowdown has reached Indian shores too. It has also derailed India's startup juggernaut. The country had added a record 44 unicorns in 2021, and in the July-September quarter, just 2 startups made it to the coveted unicorn list. Venture funding data from 2 separate sources indicates that Indian startups are in the middle of a harsh funding winter. While the global situation is not good, the slowdown is more pronounced in India. Why is that? Let us find out.
India's most valuable startup, Byju's, is laying off nearly 2,500 or 5% of its employees as part of its optimization plan. Other startups have also cut their headcounts in 2022. Blinkit laid off 1,600 employees, Unacademy 1,000 and Vedantu over 700. The layoffs are believed to be the result of a global funding slowdown that has also hit Indian startups this year, forcing them to conserve cash and discipline themselves. The slowdown has been more pronounced in India. Analysis by CB Insights showed that in the third quarter of calendar year 2022, India's share of total venture capital funding that went to Asia fell by nearly half to 14% compared to 22% in the second quarter. During the same period, China's share went up from 34% in the second quarter to 42% in the third, even though overall VC funding shrank in Asia. China's share also rose despite Beijing's crackdown on tech companies and apprehensions among PE funds. Total venture capital funding in Asia stood at $20.1 billion in the third quarter, down from $29.8 billion in the second. Quarter on quarter, global VC funding and that of the Asian market declined 34% and 33% respectively. However, Indian venture capital funding fell more steeply. VC funding in India crashed to a 10-quarter low in the third quarter of calendar year 2022 at just $2.8 billion across 387 deals. This was a 58% decline compared to the $6.6 billion in VC funding across 404 deals in the previous quarter. The third quarter numbers also represented the lowest level since the second quarter of calendar year 2020, when the COVID-19 pandemic hit the global economy. On a year-on-year basis, the third quarter decline was even sharper, with Indian VC funding at less than one-third of the $9.8 billion clocked last year. Reports indicate the unicorn rush is also slowing down. According to venture intelligence data, India minted 21 new unicorns in the first 9 months of calendar year 2022, compared to 30 during the corresponding period for 2021. Startups valued at $1 billion or more are popularly known as unicorns. But what are the factors spoiling the party for startups, particularly in India? Traction co-founder Neha Singh points to global macroeconomic conditions, particularly the fears of a global recession, as a reason behind the slowdown. According to Singh, the funding slowdown in India is expected to continue for the next 12 to 18 months, and its effects are expected to intensify going forward. And why is the slowdown particularly pronounced in India? In his column for Business Standard, Ajay Shah, a researcher at XKDR Forum, may have highlighted the reasons even before the recent numbers came out. Shah explained that while the Indian VCs and PEs had great success with several IPOs, many of the richly priced ones fared poorly after the listing date. This has not only made it harder for others to list at rich valuations, but it is also feeding back into the funding environment at earlier stages. Shah also pointed to the changing financing conditions worldwide. According to him, the rate hikes in developed markets have triggered a retreat of global capital from risky and illiquid assets in favor of developed market assets, causing turmoil in exotic assets such as startups.
When the US gets a fever, the entire world catches a cold. And I think a lot of the funds that Indian startups were raising was mostly from venture capitalists and LPs in the US. Between, let's say, 2014 to 2017-18 or pre-COVID times, a lot of the funds were raised in models which were completely experimental. Angel investors got hooked onto the idea that as long as they're investing in a large market and pedigreed sort of entrepreneurs, they will have their valuations, go up the moment venture capitalists come in. And there was no way for a venture capitalist to not participate because the risk of losing out was just way too high. And of course, the valuation game sort of started, playing out to an extent that it's now come to a point that the confidence is too low because the companies that did get valued at very high amounts did not really perform as well as they should have when they IPO'd and went into the public markets.
According to PwC India's Q3 CY22 startup report, while the decline in funding was noted across all stages, early stage deals were the least affected. PwC's India Startups leader Amit Nauka believes early stage startups would be able to raise capital more easily as they were typically more insulated than late stage deals from fluctuations in the public markets. So the important questions are, who will be the worst hit and which type of startups will prove to be relatively resilient?
If the startup is at a life cycle where they still need further a lot more funding before the unit profitability is proven, you are likely to see that funding cuts down there. I think that's what would have happened here. Also, I believe that a lot of funding will tend to move towards where consumptions are likely to be more. So for example, B2B or funding for B2B companies, B2B startups, technology deep startups rather than consumer spending related businesses.
The slowdown is here to stay and will separate the wheat from the chaff. Those who have been chasing high valuations and market share at the cost of profitability and a viable business model will have to mend their ways or perish.
Despite a bleak global background, top IT giants including TCS, HCL Tech and Infosys have wrapped up their September quarter earnings that broadly came in line with the street's expectations. So what do the Q2 results indicate for the IT sector amid growing fears of recession? We find out in our next report.
High inflation and rising interest rate environment has seen global agencies such as the IMF and World Bank downgrade global growth estimates, raising recession fears. However, India's large cap IT companies TCS, HCL Tech and Infosys broadly withstood these concerns in the July-September quarter. Among frontline companies, TCS and HCL Tech beat expectations supported by sustained demand for digital initiatives. The companies posted quarterly revenue growth of 3.8 to 4% in constant currency terms. Wipro, on the other hand, disappointed the street with a 9% year-on-year drop in profit and a less than expected revenue growth of 14.6%. Most companies reaffirmed that they did not witness any signs of demand slowdown, but they remain watchful of trends in key Western markets like Europe. Experts, however, say that the robust deal wins and the commentary on demand outlook hint that near-term growth is likely to stay intact.
The commentary for the business outlook looks quite comfortable in terms of deal pipeline. In terms of the current earnings underway, good that there is no major disappointment because the street was going in with an expectation that there is going to be downward earnings. So you've already seen about 25 to 30% correction in IT index and respectively for the other stocks. I think all these recession fears and budgetary cut are already priced in. If you are looking at long term, then maybe you should deploy 25% of your investable capital. Suppose if you want to invest 100 rupees, then maybe 25 rupees worth of investment should be done at current levels, and on dips you should add the stocks.
Even though attrition in companies remained elevated at above 20% levels, a sequential margin improvement in the range of 16 to 90 basis points has provided some comfort. Analysts expect margins to continue to improve going ahead as they believe attrition will likely taper down from here.
We do expect in the medium term some tailwinds of normalization and attrition or even subcontracting and utilization and pricing acting as levers for margin in the near term. But attrition, although on an LTM basis, it looks flattish for the companies that have reported. The quarterly annualized attrition number is actually trending down. So on an LTM reported basis, it's going to start looking downtrending in the next 2 to 3 quarters. So going forward, we are building in margin expansion for most of the companies in Q3, Q4, and those would be another set of positives.
According to technical charts, shares of Infosys could remain range-bound in the next 3 to 6 months between levels of 1600 to 1200 rupees. While those of TCS and HCL Tech could see a good run on crossing levels of 3,200 and 1,000 rupees respectively. Wipro, on the other hand, could see a fresh sell-off on breaching support of 378 rupees. Today, markets will react to US retail inflation reading, while stock-specific action will likely be seen in Infosys and Bajaj Auto.
Pandemic disrupted economic activities across the world, throwing shocking growth numbers. India's GDP growth too fell in the negative zone in 2020. But next year, when there was a slight rebound in economic activities, the growth numbers again threw a surprise. But this sudden jump in GDP growth was due to the previous year's low base. Our next report tells more about it. If we take any data point or index, it is often contextualized by comparing it with a reference point, which is usually the same period of last year or the previous month. Now, this reference point or base can have an effect on the result of the comparison, and this phenomenon is commonly referred to as base effect. If the base for which the comparison is made is low, then the outcome is the result of a low base effect and vice versa. When comparing two data points, choosing a reference point will be crucial, as the base effect can highly distort or mislead the interpretation of numbers. The base effect could also result in major differences in percentage comparisons. If we choose a reference point that is too low, there could be an overestimation, and if the base is too high, it could result in gross underestimation of the situation. If we take the May industrial production numbers, for example, the growth rate is unusually high, as last year's base was impacted due to the coronavirus pandemic. However, IIP growth was up just 1.7% compared to pre-COVID periods, and the manufacturing is in fact lagging. Choosing a different reference point, that is pre-COVID level, resulted in a better understanding of how the industrial activity in the country is actually performing. Industrial output is only one example, and abnormally high or low economic estimates are often the result of a base effect. A year after the pandemic hit, GDP growth rates were unusually high as the lockdowns stalled the economic activity during reference time periods. India's GDP grew by a massive 20% in the first quarter of FY22 on the back of a low base when the economy contracted 24% in the same period previous year.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A base effect can also make it difficult to precisely assess inflation levels over a period of time. That's all for today. Catch the next episode of The Morning Show on Monday. Bye-bye for now.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.